Apple $5 trillion warning. Success or a risky market bubble. Apple Inc.'s $5 trillion valuation risk demands you to build stronger capital strategy and secure business resilience. Apple briefly crossed a $5 trillion market value on July 28, 2026, becoming only the second publicly traded company after Nvidia to achieve this historic milestone, showing you how disciplined execution can reshape investor confidence. Less than 1 year after surpassing $4 trillion in October 2025, Apple advanced to $5 trillion, proving that consistent financial performance often compounds faster than many businesses anticipate. Apple's stock climbed roughly 24% year-to-date and nearly 60% over the previous 12 months, reminding you that markets consistently reward companies delivering dependable operational excellence and profitability. A $5 trillion valuation exceeds the annual economic output of most countries, demonstrating that disciplined business models can create extraordinary enterprise value beyond traditional economic comparisons. Apple strengthened investor trust through disciplined capital allocation, ecosystem expansion, pricing power, and customer loyalty, showing you that sustainable strategy often beats short-term market excitement. Unlike competitors spending hundreds of billions on AI infrastructure, Apple maintained relatively restrained investment while preserving strong operating cash flow, proving that financial discipline remains a competitive advantage. Institutional investors increasingly prioritize free cash flow instead of revenue growth alone, encouraging you to focus on sustainable profitability before chasing aggressive expansion or headline-grabbing growth. Apple demonstrated that ecosystem retention, disciplined capital expenditure, and stable profitability can support premium valuations even while interest rates remain above the ultra-low levels of the previous decade. Strong operating cash flow continues supporting Apple's large-scale share repurchases, research investments, and shareholder returns, highlighting why liquidity remains one of the strongest strategic assets any business can build. Apple's rapid journey from $4 trillion to $5 trillion reflects how investors increasingly reward recurring cash generation instead of businesses merely expanding capital expenditure without proven commercial outcomes. More than 2 billion active Apple devices worldwide continue generating recurring revenue through subscriptions, cloud storage, digital payments, and software integration, strengthening long-term financial resilience beyond hardware sales. This diversified revenue model reduces dependence on individual iPhone upgrade cycles, helping Apple stabilize earnings while supporting premium valuation multiples despite changing consumer purchasing behavior. Large pension funds, ETFs, sovereign wealth funds, and institutional investors increasingly concentrate capital into dominant technology companies, making you aware of growing market concentration risk. Greater investment concentration improves liquidity, but it also increases market sensitivity whenever regulatory changes, geopolitical tensions, or disappointing earnings affect a handful of mega-cap technology companies. Apple's achievement should inspire you to prioritize operational discipline, customer retention, ecosystem expansion, and capital efficiency instead of simply celebrating impressive valuation milestones. L-Impact Solutions believes Apple's brief $5.036 trillion market capitalization deserves disciplined analysis because long-term enterprise value always depends on operational performance rather than market excitement alone. A $5.036 trillion valuation means investors expect years of sustained earnings growth, expanding free cash flow, and consistent execution instead of another successful iPhone product cycle. Enterprise value ultimately depends on return on invested capital, operational excellence, and disciplined capital allocation, encouraging you to measure success beyond temporary market capitalization figures. Many executives mistakenly believe larger spending automatically creates stronger competitiveness, but Apple demonstrated that disciplined investments often outperform excessive capital expenditure without measurable commercial returns. Several technology competitors committed hundreds of billions of dollars toward AI infrastructure, while Apple pursued a more conservative approach that still strengthened shareholder confidence through superior financial discipline. Apple's strategy shows you that pricing power, ecosystem monetization, disciplined investment, and customer retention frequently generate stronger investor confidence than aggressive spending without commercial justification. Apple and Nvidia each approached or exceeded $5 trillion, increasing concentration across global capital markets and making broader financial markets increasingly dependent on very few technology leaders. Pension funds, mutual funds, ETFs, and sovereign wealth funds holding concentrated megacap positions face greater exposure whenever earnings disappointments or geopolitical disruptions emerge unexpectedly. Despite impressive financial strength, Apple still faces structural challenges, including longer smartphone replacement cycles and slower expansion across mature global markets. Supply chain dependence across Asia, evolving semiconductor costs, and growing regulatory scrutiny continue creating strategic risks that premium valuations leave very little room to absorb. Investors already price in sustained operational excellence, meaning even small execution mistakes can quickly trigger significant valuation adjustments when expectations remain exceptionally high. L-Impact Solutions reminds you that Apple did not build a $5 trillion company through hardware sales alone, but through decades of disciplined ecosystem development and strategic execution. Nearly 5 decades of ecosystem development, more than 2 billion devices, recurring services revenue, premium branding, and integrated hardware-software created advantages that cannot be copied overnight. Businesses should benchmark financial quality using free cash flow conversion above 90%, operating margin expansion, recurring revenue, customer lifetime value, and capital efficiency instead of headline valuation. Pursuing valuation before profitability often weakens balance sheets, reduces investor confidence, and raises financing costs whenever credit conditions become tighter across global financial markets. Global investors increasingly reward businesses balancing innovation with profitability, preserving liquidity, and generating predictable cash flows throughout multiple economic cycles rather than speculative growth alone. Companies sacrificing financial discipline while chasing fashionable growth narratives often expose themselves to refinancing risk, valuation compression, and declining shareholder confidence during challenging economic environments. Every strategic investment should clearly demonstrate expected internal rate of return, payback period, net present value, and measurable operational milestones before significant capital commitments are approved. Leading organizations regularly review capital deployment every quarter, redirecting investments toward initiatives producing the highest long-term economic value instead of the greatest publicity. You should prioritize recurring revenue because subscription services, maintenance contracts, software ecosystems, warranties, and retention programs improve cash flow predictability and enterprise resilience over time. Apple's ecosystem proves recurring customer relationships continue generating value long after initial hardware purchases, creating stronger financial stability through multiple business and economic cycles. Technology investments should support measurable goals like reducing operating costs by 10 to 20%, improving customer retention by 5 to 10%, or shortening development cycles by 20 to 30%. AI, cybersecurity, cloud modernization, predictive analytics, and automation deserve investment only when measurable financial outcomes justify spending rather than simply following industry trends. Organizations generating more than 40 to 50% of revenue from one customer, product, supplier, or region expose themselves to elevated operational and financial risk. Diversifying products, customer segments, geographic markets, and recurring services reduces earnings volatility while strengthening long-term enterprise resilience against unexpected economic disruptions. Strengthening supply chain resilience through dual sourcing, diversified suppliers, inventory monitoring, logistics visibility, and procurement analytics prepares your organization for future geopolitical uncertainty. Executive dashboards monitoring operating margins, working capital, cybersecurity, productivity, customer acquisition costs, and enterprise risk help leaders make faster evidence-based strategic decisions. Organizations consistently monitoring 25 to 40 executive KPIs usually identify operational problems earlier, allowing timely corrective action before profitability suffers significantly. Leadership capability, succession planning, executive accountability, collaboration, and disciplined governance strengthen organizational resilience during uncertain macroeconomic and competitive business environments. Businesses should continuously monitor free cash flow margin, return on invested capital, EBITDA margin, recurring revenue, innovation success, and revenue per employee for sustainable value creation. Enterprise-wide risk management should evaluate financial, technological, regulatory, cybersecurity, geopolitical, operational, and supply chain threats before they significantly affect long-term business performance. You should conduct structured stress testing at least twice annually, preparing your organization for recession, inflation, higher interest rates, trade restrictions, and volatile capital markets before disruptions occur. Capital discipline remains essential because overpriced acquisitions, excessive leverage, poor integration, and unjustified technology spending frequently destroy long-term shareholder value despite optimistic projections. Strong boards benefit from expertise across technology, finance, cybersecurity, manufacturing, regulation, and international business, strengthening oversight during major investment and capital allocation decisions. Businesses should continuously monitor customer, product, geography, and industry concentration, ensuring no single revenue source creates excessive financial dependency during economic uncertainty. Cybersecurity is no longer merely an IT responsibility because zero-trust architecture, penetration testing, employee awareness, and multi-factor authentication directly protect enterprise value and investor confidence. You should closely monitor inflation, benchmark interest rates, currency volatility, sovereign debt, labor markets, commodity prices, and trade policies because each directly influences profitability and investment decisions. Companies maintaining stronger liquidity reserves and diversified funding structures generally perform better whenever tightening monetary policy increases financing costs and economic uncertainty across global markets. Innovation governance should evaluate technical feasibility, customer adoption, market demand, commercialization readiness, scalability, and expected return before approving additional research and development investments. L-Impact Solutions advises you to regularly reassess valuation assumptions because markets rapidly reprice businesses whenever earnings expectations, competitive dynamics, regulations, or interest rates materially change. Apple's $5.036 trillion valuation proves disciplined capital allocation, pricing power, ecosystem economics, and recurring revenue remain powerful competitive advantages despite elevated interest rates and cautious technology spending. Within less than a year after crossing $4 trillion, Apple delivered roughly 24 to 25% year-to-date gains and approximately 60% 12-month returns, outperforming every other Magnificent Seven company. L-Impact Solutions encourages you to measure business success through operating cash flow, recurring revenue growth, return on invested capital, customer retention, and capital efficiency rather than valuation headlines. A handful of megacap technology companies now dominate global equity indices, ETF allocations, retirement funds, and institutional portfolios, increasing systemic market risk whenever their earnings disappoint. L-Impact Solutions concludes that market capitalization may fluctuate quickly, but disciplined governance, resilient business models, recurring customer value, operational excellence, and sustainable cash generation create lasting competitive advantage. Can your business withstand investor panic? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.